Hello and welcome, everybody. My name is Steve Maldonado, and thank you for joining us for NuView's workshop series on realistic real estate in 2023. Just a quick disclaimer before we get started. NuView is a passive IRA custodian and custodies IRAs, 401ks, ESAs, and HSAs for the purpose of alternative asset investments. We are a passive custodian and do not endorse any of these investments. Our investors are encouraged to do their own due diligence on these investments. However, if you are interested in discussing investing through a self-directed IRA, either tax-free or tax-deferred, please give us a call to discuss that further. Today, we are joined by Mark and Bryce Ocepek. Mark is the managing partner for Anabasis Equity Partners, and Bryce is the executive vice president. We're happy to have them on today to be discussing a pretty interesting asset class, which is distressed real estate. So without further ado, Bryce, Mark, thanks so much for joining us.
Yeah, thanks for having us, Steve. We appreciate it.
Yeah, absolutely, Steve. Thanks so much, and appreciate Maggie and everything she's done to get us on here and discuss really what our passion is. We love investing in distressed real estate. We love to find distressed real estate, and there's a not just a science, but there's a feel to it. So Bryce and I really want to talk to everybody about it and discuss some of the ins and outs about it.
Fantastic. We'll take it away, guys.
Thank you. So first to what we want to talk about is for the viewers to define it. What is it? What does it do, and how do you find it? So what distressed real estate is basically in a simplified form, it's property being offered at a reduced price to achieve a very fast sale. And defining that is kind of like, that's our little box, but having that fast sale is what's going to give us some really good solid equity going forward. So also number two, a distressed property often results in financial loss for the seller, which is unfortunate, but kind of like buying and selling, there's going to be a somebody that's going to make money on it and somebody that's going to probably lose money on it or not make what they want. So finding that is an art. So a lot of people sell for different reasons, economic duress, problems with their debts. They get into a property that they think is better than it really was, and all of a sudden they've got this huge cash bleed. So there's issues, and we'll discuss that as well. Again, another piece, distressed properties are those that have been foreclosed on, and foreclosure and that is it's a terrible thing, but people get embarrassed, and a lot of times they hide that and they let it go longer than it really should because they can't make payments. So there becomes a problem there as well. Economic downturns bring these distressed properties out, very, very quickly. So again, also foreclosures, bankruptcies, and short sales can define some of these distressed properties. So Bryce and I classified distressed properties in categories. So what we want to do is give you some of the following classifications that we classified distressed properties in, and for some of the following reasons that I just mentioned before, but we'll define them a little bit more. So a relationship failure, that's kind of like the number one piece that a lot of times people get problems inside of their real estate assets. But the owners may be going through a separation, divorce, and require the property to be sold quickly. So to achieve this goal, as I said in the last slide, they have to reduce the price for a fast sale.
There could be times where, they need to settle whatever they're doing to finalize the divorce, and that's the last piece holding them together. So they're willing to get it gone quickly.
Exactly. Agree to that lower price for that fast sale. The second one is declining value. For some reason, the property may be losing its value, and the owner may just want to liquidate. And so, again, what are we looking at that? What's just been happening in the last year? Increased interest rates, Fed raising rates, and people having, too much debt, and they're getting pinched, losing their job, such and such. So the declining value, they want to get out of it as fast as they can, and they don't want to lose as much as they would if they waited 2 months from now. So again, a fast sale. Third thing, damage to the property or the land. There's been homes that we've bought to where I can remember one that the man tried to put a roof on himself and further damaged the property, and then had to get out of it quickly because he's going to be negatively impacted, and that's problems. So again, also catastrophic events. We live in Florida, so there you have it. There's hurricanes, flooding, and problems with major rainstorms, and this impacts properties greatly. So again, they want to try to get out of it quickly, and they need to lower that price.
And like Mark said, with declining value in 2023, with interest rates going up drastically in comparison to what they were at historic lows, it's important to understand the typical buyer making 70, 80,000 a year on their tax returns going to get a loan. A lot of people don't realize that they're giving loans based off of payments that you can make, and the interest rates changed that significantly. So people that were getting pre-approved for $500,000, $600,000, $50,000 houses before are now only pre-approved for $400,000. So that's really what is changing and the declining value for properties coming into 2023, and also with properties that have damage. You mentioned the roof. If they're not pulling permits or having the proper permitting or records with construction with the city, with properties, they could get into cases where they have liens, rolling fines, improper construction fines, all sorts of issues that put them in position where they need to sell quickly.
Yes, definitely. Next one is mortgagee in possession. Basically a borrower. This category is basically a borrower may no longer be able to afford the payments. Again, for whatever reason, catastrophic event in their life, personal life, job, moving, such and such. So this requires obviously the bank to sell the property to recoup their amount. So this is a point that we're going to talk about later on how to find things, how to find these types of properties. But this is one where I can think back where Bryce and I bought a piece of land, and it was in that category. And we got it from the bank. Bank had us come in because we had a relationship with the bank. They asked us to come in to take a look, see what this property was all about, and to see if we could find a buyer for it. And I turned around and looked at the guy and said, this one looks interesting. Yeah, I think I could get a buyer. And he's like, okay, who? And I said, me. So there you have it. You get these at a really good opportunity. The bank doesn't want to own these properties. They do not want to own these properties. They want the cash and they want to sell it. So what we've done is that ability to have that relationship with them, and they trust us to come in there and give them a fair valuation for that. Again, Bryce mentioned it a little bit in the beginning, but a deceased estate or a death in the family. So this one is another category that I kind of talk to people, and as investors or taking these bits that Bryce and I are giving to them, they need to kind of be like they need to look at themselves as investigators, keep their investigator hat on, and look at it as like you're talking to these people, you're talking to banks, you're talking to networks and people that, again, this is a terrible event, but these estates need to get out of these properties because they need to liquidate because they have multiple people in the estates or the trusts, and it's not, they don't want it. They're like the bank. They do not want to hold real estate. They want cash.
Yeah, and they have to go through what's called probate whenever a seller dies and they're leaving the property to a trust, or a family member has to go through probate, and in that probate process, usually the new owners of the property are looking to get rid of it, and more often than not, whenever the person is inheriting the property that they haven't been to their entire life, and then they inherit it and they go and walk it and they realize nothing's been updated since 1970 and it's falling in on itself. They don't know what to do with it. That's when you start to, have people really start to prepare for rapid sales whenever they're going through that probate process.
And we had one of those, and there were back taxes of hundreds of thousands of dollars, and it just waited in probate. I don't know how long did that one take. That was like,
well, I think
4 or 5 months.
I mean, that's how long I think we were working on it, but their back taxes were several years.
Yeah, multiple years.
And whenever we walked the property, it looked like Jumanji.
Yeah,
but,
it was bad. It was really
we made
bad.
money on it.
Yeah.
So
two things that I'd like to say about this, and Bryce can add to it if he wants. But for investors, you need to be realistic on price valuation. On that, these people are already getting beat up. There's a point where they're not going to sell. They're going to have to hold it if you're like too unrealistic. So be realistic. Be the investigator. Get down and sharpen your pencil, dig in there pretty deep to get a really good, solid valuation. Also, as Bryce said, this property looked like, it was a mess, just like Jumanji. It was like vines everywhere, trees. It was crazy. So check the underlying condition of the property, because a lot of that, what happens is that, you have a lot of wood rot problems with ACs, multiple years where, family members or, trustees don't do anything to it.
And a lot of people don't think about the insides of the walls in the property, that things that go unseen to the average real estate buyer. As you walk into a house, the first thing you think is, oh, let me update the kitchen and the bathrooms and the flooring and the paint and make it look pretty. But you're not thinking about the electrical wiring, whether or not it's copper or cloth or aluminum, and you're not thinking about the plumbing systems and whether they're galvanized piping or whether it's got all the PVC in there, checking the septic tanks and water valves, and making sure all the actual systems in the property in place have the proper condition, or those need to be replaced, because at the end of the day, those are really the big ticket items that cost the most, more than just cosmetic renovations. Those are the things that really cost a lot of money, is those big ticket items: electrical, plumbing, roof, AC systems, etc.
Because if you're trying to flip it or even hold it for forced appreciation, 72 months later when you want to sell it, the problem that you could get into is that these banks, FHA and VA, if that's who your buyer is going to be, they're not going to let them be approved to buy it if they're older electrical systems, plumbing systems. They will make you.
They'll make you go back and replace it before they approve the loan or the insurance.
So watch your prices, but don't be a cheapskate, and
check your conditions.
Yeah, check your conditions.
Do your underwriting.
I'm sorry. A couple other life events that we'd like to talk about is just person moving to another state to be closer to a family, and also job relocations. So in your network, as you're networking with you're in investor networks or in, any of your real estate information people and systems, just talk with people. And, oh, so you're getting a job relocation, are you moving? Yeah, I need to sell my house quickly. Oh, okay. So just have that network, really a deep network, and you can really get a lot of life event opportunities with that. So again, kind of this point is, our topic of, so why invest in distressed properties? And, one of the main reasons is you can get instant equity upon, settlement, because if you get it at a really good price, which Bryce and I have a very strong investment philosophy of you make money on the buy.
Mm-hmm.
That's how you make money. So you may want to get, creative. You want to, obviously look at that property, get that evaluation, be very good with spreadsheets and your analysis. And then you can really know what price to offer at, and that's where you're going to make your instant equity.
And there are situations where if you really do buy it right, you could, even without making any repairs or renovations, you could list it for sale the next day and just resell it.
True.
So that is also a possibility. But
and another one is in, why invest in these properties? It's rapid settlement. Distressed properties usually settle quickly because the seller is seeking, the rapid sale, as we talked about before. They need liquidity. Also, negotiation flexibility. These sellers, usually give you good terms because it benefits them. They want out. They are willing to, do many creative things. So, get creative on it. Sometimes they even, seller notes or whatever.
Yeah, you can do subject to the mortgage financing. You could do seller financing. You could, put together, different creative financing strategies with somebody that's open to allow you to assume their mortgage, or do different things that you can come up with to be able to get into these properties with less amount of cash and still get a great return without having to part with as much money.
Here's another piece that Bryce and I really preach to investors, whether you're investing in our fund, which how we run our fund, or whether you're doing your own, is you need to diversify. You need to have diversification in your portfolio. Make sure you have asset allocation on that. So if you're, the way we do it is we'll have commercial, residential, multifamily, and storage units. So we'll keep those 4 classifications in our real estate portfolio for diversification. We're not going to put all our eggs in just single family or in distressed only. We'll have a portion of that will go to distressed, because you don't want to have a market turn on you and then you sit there with everything in single family, or everything in multifamily, or everything in storage. You want to mix between that. You want that portfolio theory diversification, so it protects your portfolio, and you also have and with that, make sure you have that margin of safety. What we call margin of safety is for keeping a good hunk of your portfolio liquid, so you can move quickly, and I call that margin of safety. So you have properties with a margin of safety of cash. So again, just some of these continued. Buying distressed property means that you could stand a good chance that you get the price below market value, which that's what your goal is. Okay, but take caution. 1, 2, 3, and 4 here. Know what you need to repair. Know what you have to perform, because most of these things are going to be as is. That's it. You better check these things out, because once you're stuck, you're stuck. So substantial amount of money also needs to be put down to make these repairs. So make sure you have your budget and your margin of safety of cash ready to go. Make sure you have the correct inspection team and the correct construction team. Make sure they know what they're doing, what you're getting into.
Yeah, you don't want to use, inexperienced subcontractors that may, be willing to work for less money, but then they, you know, create a really low quality product, and then you have to go in and do it all over again, especially when you're trying to sell some of these assets to FHA or VA buyers that have to pass different inspection standards to be able to qualify for the loan. The house has to qualify for the loan just as much as the buyer does. So you need to make sure that you are, meeting Florida building code standards, and you're working with a general or at least contractors. You can manage project if you want. I suggest using a general contractor, and doing your due diligence up front to understand, if you're using private or hard money, how you have your budgets in place, what you need to spend and bring to the table. And then that last piece on that after repair value is important. We talked about the estimates on repairs, but after repair value is important, especially right now in 2023. We're seeing interest rates go up, so we're not running comps on 6 months back anymore. Whenever we're running comps on a property, we're only using properties of top condition that have sold within the last couple months at the new higher interest rates. That's really what your ARV is. And then we're even sometimes taking 5% off the top of what the ARV is in preparation for any continual rate hikes here moving forward. So stay in touch with the market, make sure you're running your ARVs and your estimates and your calculations the correct way, so that you don't make any wrong moves.
And with your construction teams, my advice to you is do not cut corners to try to be cheap. Make sure you get all the permits. Make sure you do everything right with your construction, because it'll pay off in your forced depreciation in the end. So how to find distressed properties, how to find what we had just talked about.
So, a big thing that we talk about with our people and our team is, driving for dollars. And it's exactly, what it sounds like. You're driving to make money, and you're driving through, different neighborhoods, whether it's, low income neighborhoods, whether it's, a neighborhood that just got hit by a hurricane, whatever it is. Think outside the box, try to find areas that have distressed properties, and be able to identify them with the significant visual characteristics of distress. And it can be things that are common sense: boarded up windows, a tarp on the roof that's needs to be replaced, or wood siding looks like it's rotting, or there's other, significant aging, visual necessary repairs that you can see just by looking at the property. Make a list of these properties, take down the addresses, and invest time into contacting the owner of these properties directly. One of our acquisition directors, Ernest, has a good saying: 6 up, 6 down. If you look at a property that you're really interested in buying, door knock 6 houses up and 6 houses down, and ask, hey, do you know, if you're not able to get in contact with the seller themselves, let's say it's vacant, do you know who owns that house? How can I get in touch with them? You can mail them letters. If it's property record, public record, you can pull it up and see what their mailing address is. You can use different tactics to try and contact them directly. So that's what we call driving for dollars. You can see here some visual examples of distressed property, kind of what I talked about before. Roofs falling in, boards on the side. You can see in the bottom left, there's that actual wood siding is starting to rot there a little bit, and some of these properties are obviously vacant and in disrepair. But this is really what you should be looking for as you're out and about, and you're wanting to find a good deal. Another thing that I train with people that work with us is leveraging on market opportunities. Whether or not something is already for sale, that you may be interested in, go after it. But there is tons of stuff that is already for sale every day that is in distress, and a lot of times it'll reflect in the purchase price. You'll see 6 houses in a neighborhood that are all listed for 300,000, and then one goes up for 200, and it needs a little bit of work, and they need to get out of it quickly, and it may piss the neighbors off, but that's just the situation. And there are tons of distressed properties that are on these services every day, these multiple listing services. I advise working with an investor-friendly real estate professional. I'm a broker, and all the agents that work for us here at Anna-Based Equity Partners are all licensed real estate professionals, but we're investment real estate professionals. So find somebody that has that experience in your area that you are comfortable working with, that can help you identify these potential properties, because those agents are going to also have the experience in analyzing those types of properties, making sure that you're paying the right purchase price, because that is a big killer. You make money on the buy. If you overpay for a property, that's when you'll lose. We also talked about diversification before, investing into single family, multifamily, storage, commercial. A way to do that is by leveraging multiple listing services. LoopNet and Crexi are both different public commercial real estate exchange platforms. The traditional MLS is for brokers and realtors for traditional single family homes, and Zillow for sale by owner. I talk about for sale by owner a lot. Not a lot of people that are just traditional buyers that get with a lender and get a mortgage and buy a house don't ever think to get on Zillow for sale by owner. And there's a lot of opportunities on there. People that think that they can sell their house themselves, but they don't really have the capabilities to do so. And they may have, just some distress on their property as well, and they don't want to pay commissions, whatever the case may be. So you can find multifamily, commercial, single family, self-storage, all sorts of different opportunities through all of these platforms, and be looking through them daily. Find the good opportunities, find the ones that are priced well, that have value add and need work, and continue to run analyses daily. Another thing that you can use in your search for distressed properties is data extraction, and there's tons of different companies and opportunities that pull data, lists, all sorts of things. One that we use sometimes is PropStream. So that's a provider that you can look up and do a little bit of research on if you're interested in it. But you can create lists of property owners that may be in distressed situation, and this data is pulled in real time through public record. So recent divorces, recent liens, notices of lis pendens, which is the beginning of foreclosure, vacant properties, owners that are out of state that own properties. They own properties here in Florida, but they live in New York, or they live in other places, and maybe they have a situation where they just can't keep up with their property anymore from long distance. So you can pull these kind of data lists from different providers and be able to call, text, email, whatever outreach program that you decide to use, but you'll be able to have the data to outreach to them directly and get in touch with them. So that's one really important way you can get in touch with some of these. I wanted to talk about Bandit signs today as well. I am not recommending you use them, but I wanted to at least touch on the topic. So I mean, it's a common practice in the distressed property real estate investment world to use and plaster street corners and roadways with what are known as bandit signs. They're called so for a reason. They're called bandit signs because they are illegal. They're used by tons of investors and different people across the country for a reason, because they're intentionally ugly. And the reason why people use them is because, we talked about a little bit before, people that are in foreclosure or different, situations in which they want a fast sale, they don't want their neighbors to know about it. They don't want to list it on the open market and put a sign in the yard and say, hey, I'm in foreclosure, I'm getting a discounted price for my property, please come and get it. It's embarrassing. They want to call a discreet ugly sign on the side of the road and get a quick cash offer and close it and walk away from it and never think about it again. So that is really the purpose of these signs. So if you do decide to use them, I suggest doing some research on the laws in your area. Try and get permission from business owners in different areas that will allow you to put these signs up on private property or different public areas that you have the permission to do so. And I would do some research on it, but it's a really interesting way in which you can find distressed properties. That would be, what we would call a hot inbound lead, where they're calling you directly, and
they want to sell.
They want to sell. Yeah. So another one is online advertisement. It's 2023. Think outside the box and leverage technology. And another thing that Mark talked about before, that we didn't touch on too much. I know he talked about the banks, but really use your networking. I mean, get in touch with brokers, get in touch with bankers, get in touch with people that may have access to a knowledge or a database or a network of people that may be in distress. Talk to your local banks and get in touch with them. When you're talking to brokers, hey, do you have any pocket listings or deals that you're working on that where the seller wants to sell, but you're not really taking it to market yet because it's in crap condition? Hey, I'll buy it from you right now, cash. So things like that. Use your network, and then as far as advertisement goes, and you're thinking outside the box and leveraging technology, we use search engine optimization for our websites. We own and operate Anabasis Home Buyers as well as Anabasis Realty, and in connection with Anabasis Equity Partners, you can use Google paid ads, social media marketing campaigns, YouTube ads, Facebook ads, Instagram ads, LinkedIn, all sorts of different ways that you can leverage the social media platform to get in touch with people that may be in financial distress situations. Search engine optimization is a great one. So if you decide to go down that path, I would recommend you be patient, be a patient investor. So you'll be putting money into it, and it will take time to show your return.
And I'd like to just conclude here on this. I think Bryce had one more slide.
This was no, you're fine. This is kind of what I was talking about before. Real estate is a people business.
Yes.
Go to plenty of networking events. If you join, different Facebook groups in your area, or you search up networking and meeting groups in your area that, are about real estate investing. I mean, there are real estate investor associations and networks and meetup groups everywhere. And you can get in touch with people, wholesalers that provide assignable contracts. Property managers would be another good one. Maybe there's a property manager that manages a dilapidated property for somebody that may be looking to sell. You never know where your next lead or deal is going to come from. I tell that to a lot of my people. So really utilize your networking, utilize your online advertisement, and you can go ahead and wrap us up, Mark.
Yeah, in that, what I was going to say before was, as investors and people that are just getting into this, or if you've been into this a while, there's opportunities everywhere. You just have to find them. You got to dig. You have to dig, and we can help you in many ways. And at Anabasis Equity Partners, we also do through 401k and your IRA. We allow you, if you don't want to do this yourself, if it's too much work or whatever, we're through that IRA, through that 401k, you can invest into Anabasis Equity Partners and our real estate investment fund for our Florida real estate investment fund. And, obviously we do the work for you, and we bring you the returns. So it's an exciting opportunity. And again, opportunities are everywhere. And Steve, we appreciate the time that we could join with you guys here at NuView and with Maggie. We appreciate everything, and we'll send it back over to you, Steve.
Thank you so much, Mark. Yeah, no, great presentation, guys. Again, distressed real estate is, an asset class that we haven't really discussed much here at NuView Trust, and I think that you guys provided a lot of insight that was very helpful. I know that I learned a lot, and then more so, I think pointing out again was going to be a great question, and I'm glad that you pointed it out. Right, if we didn't want to actively invest in distressed real estate, go out ourselves and buy these properties ourselves. Is there a way to invest passively? And I think they answered that question. So through the Anabasis, real estate investment fund, clients that have either personal cash, self-directed IRA, or 401k can invest a little bit more passively. Now, we did get a couple questions submitted by our viewers. So just want to ask you.
They can do that with as little as $10,000 from their IRA or 401k.
Through you guys and NuView.
Yeah. So
perfect. And then there were other questions that were submitted by our viewers as well. The first question that came through here was, do I need to be a realtor to invest in distressed property?
So definitely not. Like I had mentioned earlier in the PowerPoint, work with an investor-friendly real estate agent for sure if you're not. But you definitely don't have to have a license to do these things, especially if you're working direct to seller. There's contracts and deals that are closed every day that are literally buyer directly to seller with no brokers involved.
Sure.
So you definitely don't need to have that license. Do I suggest getting one at some point if it interests you? Sure. If you're too busy or you're in focusing on your investing side of the business and you want to work with somebody that's experienced, I definitely highly recommend that. It can never hurt to have an inside track into the business. So no, you don't have to. I still recommend anybody that doesn't have a license to look at investing in real estate no matter what.
absolutely.
Great. Yeah. So regardless of credentials, having good relationships as well with those brokers and otherwise, referral sources can definitely help increase, your chances of success. How do I know if I'm getting a good price on a distressed property?
That's a good question. So really what a lot of people forget to account for whenever they're purchasing distressed properties is the back end in the front end costs whenever you're buying and selling.
That's right.
Sure.
Because there's the purchase price and there's the rehab, but you don't think about
Mm-hmm.
closing costs and commissions whenever you resell it, closing costs and any loan fees that you're paying throughout that process, points on hard money, different interest payments that you're making, and like I said, 6% on the back end whenever you're selling it for closing costs and commissions. You've got utilities, you've got insurance. So those are all things that you really need to make a list of and think about and account for, and then put into a spreadsheet and think about how you're gonna account for all of those before you calculate what your projected return is going to be. And usually we like to say for the Jacksonville market, anywhere between a 15 to 22% return on investment on a flip is a pretty good deal. Sliding scale depending on the ARV. And then when you're purchasing cash flowing assets, more rentals, we like to use what's called the 1% rule, where the acquisition of the property, purchase price plus the amount of rehab. So say you buy something for 100,000, you put 50,000 into it, your total acquisition costs 150,000. 1% of that being 1,500. If that's equal to what you've ran comps and you think you can rent it for 1,500 a month, then usually the numbers shake out and it's a pretty good deal.
Yeah.
Okay. Great insight. What specific issues on distressed property should cause me to avoid investing in it?
Well, again, carrying costs are going to be, people don't realize, that they get into, they see this big, huge property and they see it at, $25,000 because it's, whatever, falling down. But then you've got to look at it as if there's no cash flow there and it's going to take them, 6 months to do it or fix it up, or you've got huge carrying costs on that. And for your first one, that would probably be one that you'd want to stay away from.
I would say you'd want to really stay away from older properties, like 1920s, 30s, build properties, because a lot of times those budgets go higher than expected, and the projects take longer than expected because you have to get more inspections, more permits, more approvals, and if you're getting hard or private money on a property and you're paying 10% interest on that loan, because those interest costs on private money are much higher, usually only 1-year terms for those bridge loans, and you're paying monthly for that. Let's say you take out a $200,000 loan, you're paying $2,000, $1,800 to $2,000 a month, every month, whether or not you resell the property, whether or not you finish the rehab, whether or not it's sold. That's coming out month in and month out. So stay away from those bigger, older projects and homes unless you're really experienced and you know what you're doing.
Yeah, a lot of things unseen, right? And until you get in there, you start, working away at rehab, right? You don't really know exactly what you're working with, and surprises come up all the time, and you got to be prepared for those. So again, good point. Well, gentlemen, those are all the questions that were submitted from our viewers. So thank you for taking the additional time to answer those. For anybody that's interested in investing passively with Anabasis, you can reach out to them, anabasisequitypartners.com, or at the phone number on the screen, 904-977-5350.
Excellent.
Awesome. Thank you guys so much for having us. I appreciate it.
Mark, Bryce, thank you as well. Have a great rest of your day.
Thanks. You too.
You too.